The title of the presentation for this quarter is Not So Fast. And the reason that I thought that that was appropriate, if you think back over the last couple of meetings, there's just been a growing sense, a growing probability even of a so-called soft landing where the Fed would guide us into the economy into a place where we continue to have full employment and strong employment and domestic growth, um, and also lowering or more target-based inflation. And it looked like we were heading that way. And with some recent data over the first quarter, it's really kind of not so fast. Maybe we're not there yet. So that's the title of the presentation. What I'd like to do tonight really are four things. Is just to review the financial markets quickly, give some overview of the economy and some of the things that we're seeing in the economy in terms of headlines, um, visit with the Fed or visit on the Fed and get caught up on what they're doing. They just met and had an announcement this week, and then of course look at portfolio performance. So let's start with financial markets. Financial markets have retreated somewhat in recent weeks. As of the end of April, though, the S&P 500 was up about 5.5%. It was down from its year-to-date highs. Again, it's retreated. It's now trading at about 5,064. The Dow, large industrial stocks have been about flat, and it's been kind of consistent throughout the year. The NASDAQ, which is a tech-heavy index, as we know, has given up some of its early returns and has retained what's left of about 4.3% year-to-date return. The Russell 2000 is down nearly 3%. It really reflects a concentration of returns in large mega growth equities. The euro, the European or international developed markets, is really where they've been the global outperformer. And part of the reason is it's just valuations. The comparative valuations in developed international markets are just really attractive right now relative to other markets. And we'll look at that in a few minutes. Shanghai's come back, and across the entire world, the all country world index, risk assets are up about 4% year to date. Most of the return, the concentration of return has been, the leading sector has been communication services, and that's been driven by the likes of Google and Meta and others in an AI play. But by and large, technology and communication stocks have led the way most of the year. Market valuations, today the market trades the S&P at about 23 times, meaning that investors are willing to pay $23 for $1 of earnings right now. You can see how that relates to historical averages. It's elevated historically, but in line with what we've been seeing over the last 5 or 6 years. I talked about the concentration of returns, these what's known as the Magnificent Seven. It's a collection of large mega cap growth companies like Google and Meta and Tesla and others. To give you a sense of their PEs, on average, they're trading at about 48 or 50 times earnings. The S&P 500 is at 23. And then international developed equities, as I had mentioned earlier, are at a discount to all of that, and today traded about 16 times earnings. And I think that that's, by and large, one of the reasons that we're seeing some outperformance in the international developed markets, just because on a relative trade, they're attractive. Let's turn to yields, 10-year Treasury yields. We've seen since January a trend towards increasing yields, really a reversal from what most people had anticipated happening this year. Today, the 10-year Treasury yield is trading at 4.58%. It's rallied a little bit. To give you just a sense of what that looks like on a historical basis, here's the 10-year Treasury yield going back to 1965. So you can see it in a historical context. We continue to watch the yield curve, and we've talked for years now. In fact, it's the longest period of time of an inverted yield curve in history. And what we mean by that is that a normal yield curve, you would see short rates being lower than long rates. And an inverted yield curve is just the opposite, where short-term rates are higher than long-term rates. And very often what we're comparing is the 2-year to the 10-year Treasury. Right now, that's inverted by about 30 basis points. The 2-year Treasury trades at about 488 right now, and the 10-year Treasury at 458, so a 30 basis point delta. It's been as much as 100 basis points and more at some times. So I think that the real remarkable thing is just the duration of time that the yield curve has been inverted. And as we all know, it has a very high correlation as a leading indicator to recessions. So we've not heard the last of the yield curve yet. So on to the economy. The economy really is, I think, a dynamic of opposing forces right now. If you think about a soft landing, as you think about what the Fed's trying to do, there's opposing forces that are happening. On one hand, you have full employment, historically low unemployment, economic growth, wage growth, and a growing economy, all very positive things and essential components of a soft landing. The problem is that after falling precipitously from 9% down to about three something right now, inflation is just kind of stagnant and stuck, and it still is. It still just isn't capitulating to the Fed's target. So that's the opposing force that's happening here. So let's look at that. Talked about jobs. The March job numbers, the most recent that we've seen, we'll see another job report in the next day or two, had stronger than expected growth in jobs, positive for the economy. The unemployment rate has been well under 4% and as low as it's been since the 1960s. So unemployment is very positive right now. Domestic growth continues to hang in there. The fourth quarter revised numbers were positive 3.1. The expectation is that we'll see a continuation of that trend when we get numbers here shortly. It may not be as strong as 3.1, but nonetheless, it'll be positive growth based on expectations. And all of this has driven a strong market. The S&P 500 was up over 10% earlier in the year. We've seen it come down, as we saw before, down to about 5.5% year-to-date return. But nonetheless, it's a positive market. So all of this is kind of underscoring the foundation of a soft landing. The problem and the opposing force is inflation. March numbers were CPI came in at 3.5%, and you can see how it had fallen, really precipitously, but just is kind of stuck here in this 3.5% range. PCE is even a little bit more dreary. PCE, as many of you know, is personal consumption expenditures. It strips out the more volatile components of CPI. It's the Fed's favored inflation indicator. It remains elevated to targets. There's no doubt about it. So what's that to leave the Fed to do? So let's look at the Fed. The Fed met just earlier in the week and had an announcement on their Fed funds rate. They're holding Fed funds target at 5.5%, unchanged over the course of several meetings now. This is at a time when the market largely had thought that they would be telegraphing near-term rate reductions or even enacting some uh, cuts in the interest rates. But they are really, the Fed has really kind of dug in their heels and said we're not going to proceed until we see more evidence of inflation moving closer to target. So again, these opposing forces. Nonetheless, the Fed does expect to have lower interest rates as we see a dot plot going forward. You can see the consensus in terms of what the Fed funds rate will do over the next year or two. That really hasn't changed. It's just more the timing. And that's, again, back to the title of the presentation tonight, not so fast. So the trajectory of interest rates has slowed for sure, and that really has had an effect across all risk assets in the market.